Welcome back to another episode of the Beginner Day Trading YouTube channel. I thank you guys for being here. If you guys could, please hit that thumbs up as we continue to grow the channel. I greatly would appreciate it. So today we're going to be talking about how to trade options in the WeBull desktop. And so we're going to get very descriptive, show you guys everything you know and how to navigate. Now, when you sign in, you'll see a screen that maybe look like this as default. I don't know. Maybe it's a watch list. Maybe it's stocks. I don't know. But when you come in, what we're going to be focused on is the tab that says options trader. Okay. So the options trader is going to give you the tools you need to trade options on this platform. So we're going to click there. Now, when you open up the options chain, the options profile, it's going to look something like this. Okay. Now, you'll notice you'll have maybe a watch list here. Okay. There's other different options you can choose, but by default, I believe it's going to be a watch list. Now, your watch list is easy to set up. Okay. So, what you would do is you would click the down arrow and then you would click where it says add watch list. Okay. You may be hard to see it, but it's in blue. And then you can type whatever you want the watch list name to be. And then you're going to click OK. Okay. Now, if you want to add a symbol to your watch list, you're going to hit add symbol. And for example, maybe we put Tesla in here because this is one of the most traded stocks. So you got Tesla, Nvidia, QQQ, Inspire, some of the most well-known stocks and ETFs that are traded daily for day traders. Okay. Now, one important thing here, if we come down to the bottom left, there's settings. And so you're going to click trade. And this is going to help you set up your automatic buys and your automatic sales. Okay. So for example, by default at the bottom here for stop price for stop loss, meaning if I've got $10,000 and I trade $100 per trade, and I know the most I'm willing to lose is $20 per trade, guess what? I put 20% here. That way, if I'm busy, I get into a trade, I'm at work, or I'm babysitting my kids, something's going on. And I know a lot of you don't think babysitting your kids is a thing. I mean, it is what it is on that. You're watching your kids, okay? And you get into a trade and you want to take profit down at the bottom here for $20 a trade. Maybe you raise it up. Maybe you say, you know what, I'll take 40%. Okay. But sometimes, guys, and depending on the market, that 40% may not be available to you. So sometimes you don't want to be greedy and you want to set it at a realistic percentage that you could potentially get that day. Not say that you can't get that, but you know, you just be the judge of that. So once you have this set, make sure the boxes are checked, and it's going to show up in your default, which is going to look something like this, for example. So if I click here where it says buy order for a 541 call, it looks something like this. And let's say I got in for $209, for example, it automatically would trigger me for a 20% loss or a 20% gain. Okay. And so if you want to look at the graph on this thing here, it shows you what happens if this thing keeps going up, right? So if it goes to $547, guess what? On this particular option contract, you're going to get $411. And this is one of the reasons why I like this because it shows you kind of what to expect here. Now, if it goes to the downside, you can see your maximum loss could be $209. But see, this is why we set this up here to where if it did go down there far, you wouldn't lose all your money, right? So this is something you guys should know. Okay. Now let's go ahead and X this thing out and let's go ahead and get into the nitty gritty of this thing. Okay. And so I'm going to open this thing up a little bit so you can see a little bit better. And I'm just clicking and dragging the window open. Now, the first thing that you need to know about these option contracts is delta and then theta. Okay. Now, essentially, theta, this column here, is time decay. And so you'll notice it says negative 4199. And essentially, what that means is for every day that goes past, if you were holding this contract, you would lose $41. Now, the delta means this column here, you see it says 35 right here. That means for every dollar that this stock goes up, you would gain $35. For every dollar that it goes down from the point that you bought it, you're gonna lose $35. But remember, this delta is gonna speed up because we're looking at a 1 day option contract. Now, for example, if we were to go out to an October expiration date, and my kind of rule of thumb is this: if I know I want to be in an option for 1 day, I'll go 1 week out. So for in this example, I probably would go out to, let's say, September 16th. We know the markets are closed. It's a Saturday, but for this purpose, let's say if it was Monday, I would go for something like this. And you can see if I wanted to go for a call, which you see here, and we'll break that down in just a second too. Let's say I wanted to get into a call and I wanted to go for a 541 strike price, and you see this time decay is lower than the last one, but the theta is up a little bit higher. Okay, so those are important to look at. Now I'm going to zoom this in a little bit more for us here. Okay. And so now I'm going to break down some of these basics a little bit for you. So when you come in, you're going to see this tab that says order book. And when this is live, you'll see a lot of activity moving here. But I like to go where it says options. Okay. Now, within this options, right, you're going to notice that it says single here. So if you click that down arrow, it's going to show you all the different strategies you can use for different options, right? And so we'll cover some of them, not all of them, but probably some of the ones that are most commonly used. Okay. Now, another thing you'll notice is you'll see calls and then you'll see puts. By default, when you come in, it's going to show both. Okay, and it will look something like this. I'm not necessarily a fan of that. I just want to look at what I want to look at. So for this example, let's look at calls. Okay, calls meaning you're betting that the stock is going to go up. You've done your due diligence. You've looked at the charts, for example, and let's say you've got a level of support that's here, for example. You've got a level of resistance that's here, for example. All right. And basically, what that's saying, and I'm going to zoom in on this thing. Okay. I'm going to zoom in so it looks a little bit better for you guys. All right. So essentially, you can see we ended the day flat, but this line here represents resistance, meaning it's the floor, right? This represents the ceiling, meaning you want to go past this at some point. Now, for example, if we look at this particular candle here and it starts to go up above this line at the top, which is resistance, which we want to break through, and we want to show um, confirmation that it's going to stay past this line. Then we would say we want to do a call, right? So, for example, I don't really do 1 day expiration. So, for example, here I would do something like this, and to the upside, let's say, hey, I want to buy a call here, okay, because I think it's going to continue to go up and it's already set. All I have to do is hit place order. But let's say, you know what? I want to alter this. I want to bring it down to 15% because this thing may run too quick or it may fake me out. So I'm willing to lose less on this play. Okay. And so essentially, that's what you'd be looking at. So again, if I get into a call that's saying, I think the stock is going to go up. If I go into a put, that means I think the stock is going to go down. Now, for this purpose only, I'm clicking on put just to show you guys something. Okay. Let's say that a candle was coming down. We break underneath this particular line here, which is called uh, support, which is our floor, right? It comes below this. It showed confirmation with the second candle, and now I get into a put, right? So I would hit buy. This is saying I think the stock is going to go down, and so you can make money going down too. If the stock is falling, you can make money that way as well. So essentially, this is how you're going to use the single option contracts. It's either you're buying a call or you're selling a call. Now, keeping it to the single contracts, right? So, for example, if I sell a put, for example, let's say I want to sell a put at 536, right? 536 is the strike price. And if I were to sell a put within this time frame, remember that the contract expires September 9th, 2024, which this would be risky, right? This would be risky, but let's say I wanted to sell a put, right? Selling a put, and I'm not saying you're selling a put after you buy. This is just flat out selling a put, which is an entirely different option strategy than buying a put. Okay. So if you sell a put at 536, you're essentially saying, and I would take this out. This means that you want this stock for the most part. And so if I click graph, right? So if you sell a put, if the stock price stays above the strike price, which in this case is what is this, 536, you're gonna collect $111, right? That's basically what they're saying. But if the price goes below 536 at expiration, you're going to be forced to buy this particular stock at whatever price it is by expiration. So let's say, for example, the stock fell to $530, then you would be forced to buy those shares at that particular price. Okay. Very important to know. Excuse me. Now, at the bottom, you see it says max loss $53,000. That's more than likely it's not going to happen. That's saying that the stock market would crash to absolutely nothing, and that's not going to happen. Okay. So let's exit out. And now let's come back to the call side. So you can also sell calls, which is a different strategy than when you buy a call and then sell that call once you're in and out. So if you're selling a call, for example, right, you come up here, but you have to own 100 shares of this stock, right? So let's say you got 100 shares of SPY, for example, and you say, you know what, I want to sell a call, and selling a call against your 100 shares you own, and you will want to take this out because this is a different strategy here. Okay, what this essentially means is if the price does not go above $544 by expiration date, you're going to collect a premium of $96. Okay, if it doesn't go above that strike price. But if it does go above that strike price and it expires, then you are going to be forced to sell your shares at expiration, but you still will profit, if that makes sense. So you'll profit, but it's not going to be as much had you not sold your calls. Now, when you sell a call, it's essentially meaning a covered call. Okay, and so I know a lot of that could be confusing, but it just takes time to kind of get all of these things set in stone. So again, selling calls and selling puts essentially is a way to make weekly income. So you'll see a lot of people that want to generate income and they'll sell a call, they'll sell puts every week. They're doing the same thing. It's very safe. Um, and you can make money pretty consistently that way as well. Now, let's go to cover. So we talked about covered calls. So this is just a different way of doing it. Let's talk about straddles, for example. So basically what a straddle is you're buying a call and a put at the same price, and then you're gonna take the difference between whatever direction it goes. And so, although that sounds simple and easy and a good way to make money, which it is, you have to properly time when you're gonna use this strategy. And so, for example, the current price is 540. So for me, I would go with something like this 540 strike price here, which is a call and a put. And so basically, you would go ahead and you would buy. And here's what happens. Okay. For example, on September 30th or whatever it is, we've got an FOMC money meeting coming up, and the markets will be volatile. And you'll see a lot of people go into a strategy like this, which is called a straddle. So they'll buy a straddle, right? If the stock market goes absolutely ballistic to the upside, you could potentially make money. If it goes absolutely ballistic to the downside, you can make money. And you're basically just taking the difference between which way the markets want to go. But one thing you have to keep in mind, which can be risky, is the implied volatility. If the volatility goes down, as Jerome Powell, the chairman, is speaking, guess what? The value of both options can go down, right? So your call inputs value can go down. So you have to be very careful. And you should only do this when there's a lot of volatility. Okay. So be very careful of that. So we click the graph, right? It shows you um, and it shouldn't look like this, but this thing looks a little bit off. But essentially, in a nutshell, right, on a particular chart, right, it'll be a triangle shape, okay, and so or upside down triangle shape, okay. If it stays within a triangle, then you could potentially lose money. Anything outside that upside down triangle is going to give you money, right? So your right side could be your calls, the left side could be your puts, and anything outside of an upside down triangle is going to be in the money for you, okay? And that's to the extent that there's going to be implied volatility, which you have to know that it's going to be there. So for me, if I were to get into a straddle on a very volatile day, it would be very early in the day, right? So on a day like the FOMC meeting, I would get in early, like 9 o'clock. As you get, well, maybe about 10, 11 o'clock, because they usually speak about 2. I get in at about 11. As we ramp up to the FOMC meeting, you'll notice the value of those options will start to go up. So then you can make money before the meeting even starts, and be out, because you don't know what's going to happen when he starts talking. So a good strategy, and essentially, yeah, you're buying a call and you're buying a put at the same time at the same strike price. Okay. Now let's move on to, and the strangle is pretty similar. So let's go to vertical, right? So for verticals, you have you have call credit spreads, you have a call debit spread, and then on the other hand, a put debit spread and a put credit spread. No, it's kind of confusing if you haven't heard about it. Now, what I'm gonna do is change it to puts here, right? So essentially, what this is saying is, and let's keep in mind, the price is $540, and for me, I usually would go way out of the money for something like this, right? So if you want to do a put credit spread, you're essentially saying the price of the stock is not going to come below this particular price by expiration. Okay. And let me say this, guys, when you're getting into options, you don't necessarily have to hold them into expiration. Once you see you're in profit, you go ahead and take your profit. You don't have to wait to expiration. You just, if you get up 20, 30%, and that's good for you, take the profit. Now, for a put credit spread, for example, like I said, I would go further out. Um, I would change this strike to 20, but because I'm right here, you wouldn't be able to see them. So if I want to do a put credit spread, I would do a sell order. Okay. And so if you look at the graph here, it's saying that if the price goes above, um, if the price goes below 536, then guess what? You could potentially lose $72. But remember, you can always do more than one contract. So you could do five contracts. You can do whatever it is you want to do. And so you can see where it says max profit. If I did five contracts, it's saying I can make $140. But if I bring it down to one, you're looking at $28. And so as long as the price doesn't go below essentially $36, I have a potential to making money. Really, you want it to be above $37. Once you get below 37, it's gonna start eating away at your premium. So you really want to stay above $37. And if it does, you make $28. But if it goes below this 36, you know what happens. You could lose $72. But this is a safe way to really make money, especially if you go way out of the money. And when I say that, maybe the strike price that I would get into would be something like 530 and then 531 as a way out of the money strike price. Now, if you want to get out early, remember when you go in, you're gonna have to buy your way out because you sold your way in, if that makes sense. So remember that. I know it's confusing, but you'll see as you get a little bit better. Now, let's say I want to do a put debit spread, you would do buy. And so if I hit the graph here, it's saying, and this is the opposite way. If this thing goes below 536, then I start to make money. But if it stays above 536, then I could potentially lose $28. And you'll see what some strategies, some people will do uh, uh, a put debit spread here, and then they'll do a put credit spread just below. So if it were to fall, then you're gonna make money as it falls, take your profit, and then as long as it stays above your your put credit spread, then you're gonna be in profit. So I know a lot of that is confusing, but as we continue to do these videos, it's all gonna make sense. Okay. Now let's go ahead and change this to a call, for example. So let's say that, I want to do a call credit spread. So I would go to where it says sell, and let's say that I chose the 554 to 446. We're gonna sell it. And you look at the graph here, and they're saying that as long as it doesn't go above this 545, then I'm gonna make $20 for one contract. If it goes below, I could potentially lose $80. But again, you can always get out beforehand. Let's say if I wanted to do 10 contracts, to potentially make $180 as long as the stock does not go above 545. Okay. Now to the flip side, if you change it here to a debit spread, you could potentially get $720 if the stock does go above those strike prices, okay? But if it goes below or stays below by expiration, you could lose $180, okay? So those are the vertical spreads in a nutshell. Now, let's talk about iron condors, right? So iron condors are pretty much, there's two sides of the spectrum, for example, and you'll notice here the width. Okay, now you can change this width to 2. You can change it to 5, 6. I usually stick with ones for the most part. Twos. I'll use twos, but I'm just gonna stick with the auto. So essentially, right, if the price is $540, I like to be this 540 to kind of be in the middle, for example. So I would go with something like this. And so if I did a buy, for example, and you look at the graph, okay, essentially what this is saying, if the stocks go outside of this range, um, then I'm gonna collect $11. If it stays within this range, I could potentially lose $89. But for the actual iron condor, if you do a sale, you see if you say between 539 and 542, guess what that means? I could collect $89 when the market is flat, right? Let's say the market is not moving and it's one of those days you're frustrated, is it's just flat, it's not doing anything. Guess what? I get in these iron condors, right? I get in them for an hour because guess what? That theta starts to kick in, right? So on an iron condor, I'll get in a 1 day contract. That theta starts to kick in. I'm in for an hour, and as that theta's eating this up, guess what? I could collect $20 in an hour. I'm in and I'm out. I'm not sitting there holding it all day long if I don't have to. So one of the things I like to express is once you're in profit, guys, just go ahead and take it. Just take the profit. Take the profit. It's gonna be all right. Just take the profit. For me, I don't care what it is. If it's $2, I'm taking it. When it comes to trading, if it's $1, I'm taking it. If it's 50 cents, I'm taking it. If it's $100, I'm taking it. Um, but there are times where I'm a little bit more risky. But if I am, I have those stop losses are automatically set to trigger, and we talked about that at the beginning of this video. Okay, so iron condors are really good if it's going to be very volatile, or the flip side, if you're going to actually sell, then you want it to kind of remain the same. And we already talked about both sides of the spectrum there. Okay. So overall, guys, I would say this is how you can trade in the WeBull desktop app. If you want to trade options, hopefully I gave you guys some insight. And this is all knowledge I know from being in the stock market over 10 years, guys. Um, Again, never put up more than you're willing to lose. Use your stop losses. Take profits when you have them. If you find that you're too frustrated, there's nothing wrong with just getting into index funds or ETFs, or getting you some Apple, Microsoft, right? Until you get a little bit better, and you're gonna learn how to control your emotions. If you're a person that can't do that, you could have a problem early on, but I believe you can do it. Okay. Listen, guys, I appreciate you guys for being here. Please hit that thumbs up as we continue to grow the channel. And I am out, guys. Peace.